This is Daniela Cambone for Kitco News. Thanks for joining us this Friday. We have Peter Hug to discuss some of the week's top stories, including that John Paulson move, up next. And he is just so dedicated, we brought him back from vacation to get his points of view. Peter Hug, thanks for being with us.
Hi, Daniela. How are you?
Well, I'm doing excellent, Peter, and I would like to share with our fine viewers that we had a bet on August 15th, yesterday, on where gold would close, and I really think that the viewers should know that I won that bet.
Yes, I'll give you that. We based the bet on the second fixing, and based on that, you did win the bet. Based on the close, I would have won the bet, but I concede that Daniela did outguess me as to where the market would be on August 15th, and I believe I owe her some kind of exotic coffee, but I can't remember what kind.
Exactly, Peter. No sugar, please. Now let's get to the real news of the day. This week it was revealed that John Paulson, the largest investor in the SPDR Gold Trust, reduced holdings by 53% back in June. When you saw this news come out, Peter, did it concern you? Do you think Paulson might be so plugged in that he is foreseeing something that we should know?
Well, I'm not sure if he's plugged in. What bothers me with Paulson, I mean, he's been a perennial bull, and he's been right until the end of 2011, when the market hit its high of 1925, and he stayed with the position. And ironically, he almost feels like a retail investor. When I look at his trade right now, he sold half his gold position in the second quarter of this year, which from an average price point of view represents the low of the market for the last 3.5 years. So did he finally throw in the towel? I'm suggesting he probably didn't. And if he would have, I think he would have sold his entire position. I mean, he's a very, very intelligent man, and I have great respect for Mr. Paulson. And what I think he's doing here, he sold his position out, was he is now holding gold more as an insurance position by maintaining half his position. And I think he sees better returns on the remaining funds in the short term. I know he's very, very positive on the real estate market. So if he gets this call right and he moves half his money out of gold into the real estate market, then he is assuming that the economy will start to gain traction, and he'll get a better return in that asset class than he will in gold.
Peter, and in your commentary this morning, you say that the shorts have now been handed their lunch and are begging for Nouriel Roubini to confirm his $1,000 call. Roubini calling for $1,000 gold over a month ago within the next 2 years. You'll be speaking at a conference with Roubini in September in New York. Will you be asking him to confirm this?
Yeah, I may ask him that. I mean, everybody's entitled to their opinion, and I think Mr. Roubini is probably right on his call that we will see $1,000 an ounce. But you have to take it into context on what he's premising his call on. He's premising his call on a stronger U.S. economy, on higher rates, and a stronger U.S. dollar. I mean, if those things come to fruition and there are no major geopolitical issues that surprise us, $1,000 an ounce, he'll probably be accurate within the next year or two.
So if the shorts are stuffed, as you say, Peter, does the market have enough zip to push higher on the back of new buying?
Yeah, I mean, again, this is August. In almost every blog that I've written over the past 2 or 3 weeks, I've suggested that this market is extremely thin. If you really look at what's come out in the news, other than what's happening in Egypt, and I'm not downplaying some of the geopolitical risks in the Middle East, but from an economic perspective, there's really been no news in the past 2.5 weeks. And when you have a thin market like this, the pros tend to play it. The first thing they tried to do about a week ago was they tried to knock it down under 1,300 and push the longs out of the market. They were unsuccessful. So they try on the upside. And they get it through 1,300, and they get it through 1,323, which in my opinion, and I indicated, was a key level. That triggered stop loss buying from the bears that were short this market. And the market was aggressively short, both gold and silver. So as the chart patterns started to become more positive, the bears got knocked out of their positions and it just fed on itself. And then you had this rally up through 1357. I suspect that this market needs to consolidate here. If it keeps running, I'd be much more inclined to short the market than to jump onto this rally. There's been no substantial news to generate this rally other than short covering and some issues with geopolitical risks in the Middle East.
Some thoughts on silver now, Peter. We've seen silver outperform gold, but are these moves exaggerated? Could we see a pullback here?
Yeah, I mean, when the last time gold broke up through 1,300 and I suggested it might get to 1,323, I thought silver's price point should have been around the 2150, 22 level. And gold did what I expected, but silver didn't. It stayed under 20. This is, in my opinion, catch up. There's no shortage at all of silver in the market. The supply-demand fundamentals are still bearish silver in the short term. But again, I think this market was overly short, and this knee-jerk reaction on covering their shorts up to the 2250 level made sense to me. This yesterday's move over 2340 was a little exaggerated based on where gold was. I'm looking at silver moving at roughly 3 to 3.5 cents for every dollar in gold. And yesterday it moved 10 cents to every dollar in gold. So that's why I suggested that you might get a pullback in silver into the 2240, 2250 level.
So Peter, before I let you go back to vacation, what are you doing with this market?
No, as a trader, I mean, you just got to trade the levels. It broke through 22, you buy it. 37, you get out of the market. It stalled there, came down back into the 1320 range. Again, back over 1320, 25 was a buy. When it washed through 1337, I suggested 1357 was the target. It got there immediately yesterday and washed through it. 1357 is now support. You still, if you're going to ride this wave as a trader, it's a constructive market, but 1357 has to hold, or we're going to see it back down into the 1337 range first, and then 1320s. If it can hold 1357 and consolidate here, I suggest the next level, which I suggested this morning, we almost got there at the open, was 1377, and then a 1392 target would be next in my mind.
All right, Peter, thanks so much. I'll let you get back to fishing.
You're welcome. Bye-bye.
And thanks for watching this edition of For Pete's Sake. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.